and you're very welcome to this webcast on the Conceptual Framework for Financial Reporting 2011. I am Professor Robert Kirk from the University of Ulster. I'm delighted to present this session for you today. The Conceptual Framework for Financial Reporting is probably one of the most important documents that the International Accounting Standards Board has ever published. It's not an accounting standard, but it forms the basis on which basically all of the accounting standards published by the International Board are framed. And therefore for students it's absolutely vital that you understand the various concepts and principles which are involved in the framework. Particularly important whenever you get to a situation where you cannot get the answer from a particular accounting standard and you want to try to deal with it, an unusual transaction, then you will always go back to the conceptual framework and go through the logical process in that framework. In many ways, it's like a builder. When a builder puts up a house, the first thing they do is they dig the foundations. And unless they dig the foundations properly and then put the walls and then put the roof on, they won't have a house which is going to stand. And unfortunately that has been the problem over the years with the standard setting process, because often the standards were published before they've been properly framed with the firm foundations underneath them. So let's go through the document bit by bit. The main purposes in the framework are as follows. First of all, as I've already said, is to try to assist the International Accounting Standards Board in setting standards which are consistent one with another, that they're all following the same principles. That seems obvious, but it's not the case in quite a number of the standards which have even been built up to date, where some are based on trying to match the income with the rate expenditure, and others are trying to make sure the balance sheet is correct, or should I say true and fair. So let's try to make sure that in the future all standards are set in a common basis. Secondly, as the world moves closer and closer to harmonization, it is very important that the International Board and the other main standard setter, the American Financial Accounting Standards Board, get together and decide what are the key principles in financial reporting. If they don't do that, then it becomes much more difficult to produce a genuine world standard. And that is why this project is an ongoing project. And in fact, the two bodies currently are revising the framework. Thirdly, for those people who are setting standards in a national basis, and even though they're not as important as they used to be, there will be some unique situations that national standard setters need to deal with that deal with their particular culture or environment. And it's important that when they're setting the standards that they follow the same principles. This would happen, for example, in our country, where you have the Charity Commissioners in England and Wales setting standards in a SORP, a Statement of Recommended Practice for charities. So they must make sure that the logic that they bring into those particular documents follow the logic in the conceptual framework. It's also to help the preparers of accounts, because if a preparer can understand the basic principles of an account, that should make life a lot easier for them when they're interpreting unusual transactions. If the auditors understand how those accounts have been prepared, again, it makes their job much easier to interpret that the preparers have prepared the accounts in a proper and true and fair manner. And obviously, from the user's perspective, it's even better because they're getting information which is consistent. So the whole general purpose is to assist in understanding the standard setting process. So those are the purposes really in trying to draft this framework. Now, the framework itself is not a standard. It's argued to be a non-authoritative document. That's a status. But if a particular preparer gets into difficulty and does not understand or does not able to get the answer in a particular standard, they really should go back to the framework. So it is basically a backup to the standards. But there's absolutely no doubt within the documents made very, very clear that the standards prevail. So if I was looking at the area of property, plant and equipment, for example, I would have to try to find the answer to my problem in International Accounting Standard number 16 on that topic first. But if I couldn't find the answer there, then what I probably should do then is go back and try to read the basic principles in the framework. The aim of the International Board obviously is to try to reduce conflicts between the framework and the standards, and that is why at the moment there is this major project going on which is currently trying to revise the framework, and this is going to take probably another 3 to 4 years. The framework itself is a living document. It'll not be written in stone forever and ever, because society changes, the environment changes, and it's important that the framework is brought up to date on a regular basis. So as society changes, hopefully changes will occur also within the framework to bring it up to date in the world of the 21st century. One thing that the framework is very concerned about is trying to meet the needs of its users, the users of financial statements, or general purpose financial reports as they're sometimes called. Now there are quite a number of users, and it's very difficult sometimes in the same document to provide the needs of all the users in the one document. So sometimes you may have to eventually produce special purpose reports for individual users. But let's look at the users in turn. The investors in the company are obviously one of the prime users, and often why we actually prepare the accounts in the first place. We have to meet their needs, which are basically to make sure that in fact that their investment is properly accounted for in the past, and that we give them enough information to make decisions as to whether they should continue to invest in the company, or perhaps invest more money or take their money out of the company. For employees, probably less important, the annual report, but obviously employees are particularly concerned about their future employment and also their future wages and salaries. And if the company can make a profit and the profit's been properly calculated, then obviously that gives strength, if you like, that the employee will not only be in a job but also perhaps be able to get a higher wage increase in the future. Lenders are obviously very concerned about accounts because they've lent money, they want to make sure they're going to get that money back, and they also want to make sure in fact that the interest which is due on that money they've lent will be paid. Suppliers and other trade payables are mostly concerned on liquidity and making sure in fact that there are sufficient current assets to meet the current liabilities, so hopefully they're properly computed. But they're also concerned about the future viability of the company, because that means they'll be able to sell more goods to the company. Customers are concerned as well, because if they buy goods from the company, they may need those goods repaired, so it's very important in fact that the company is profitable and is able to service the replacement or repairs of that customer. And then of course governments are particularly concerned about tax, the amount of tax that the company pays, and also some of the agencies will offer grants of course in certain situations, and they want to make sure that when they're offering grants that the accounts effectively give a true and fair view and meet their needs. And finally the public, probably less important in the annual report in many ways, but increasingly a lot of information on social responsibility is being moved into the annual report to try and help meet the needs of the public. But those are the users, and those are the general needs that we're trying to achieve within the actual financial reports. Now the document itself breaks down into a number of chapters. We'll deal with those chapters in a minute. But basically it starts off by saying, what is the objective of general purpose financial statements? What are we trying to achieve here? And we'll look at that in the next slide. Secondly, it says when you're preparing a set of accounts, it's important that you have in the back of your head certain qualitative characteristics that makes that information useful to meet the needs of the users that we've just been looking at. Thirdly, and probably the most important in many ways section, is to define the key elements in a set of financial statements. I mean, the obvious things are, what is an asset, what's a liability, what's an income, what's an expense, and how on earth do we recognize and measure these elements in the financial statements. So that is the core part of the framework. And finally, it also deals with a situation where we know that there are different methods of trying to evaluate the performance of the company, and they're really judged by the way that we protect the capital in the business. Historically, over the years, we've tended to concentrate on protecting the original capital of the owners and possibly their retained profits. But we've come to realize, particularly in the 70s and 80s, that doesn't protect the wealth of the shareholders. And so what we maybe should be thinking about is maintaining capital to maintain the purchasing power of the shareholders in the company by making sure they're protected from the ravages of general inflation. Or perhaps what we should be doing is trying to protect the physical capability of the business to produce a range of goods and services, and that maintains the operating capacity or the physical assets in the business. Again, we'll cover that shortly. Now, the document in Chapter 1 states very clearly the objective. The objective of financial reporting is to provide information about the financial position of the company at the year end, the performance for the year, and changes in the financial position that is useful to a wide range of users in making economic decisions. Now, what do we mean by useful information? Well, the objective clearly brings out the fact that there are two, if you like, sub-objectives there. The first one is known sometimes as stewardship. In other words, when the accounts are prepared on an annual basis, they should make the directors accountable for what they've achieved over the last 12 months, because the directors are the stewards on behalf of the investors and other parties, and they should be made accountable for what they've achieved on an annual basis. And that's why we have the annual report, why we have often annual general meetings. But that's very backwards looking. It's important, of course, to be accountable, but it's also important to give information to help users make decisions about the future. And that's why Chapter 1 also concentrates on making information useful from a decision-making point of view. Now, the only problem with that is that moves away from historical cost information and tends to push us towards the use of more fair value reporting, because fair value is much more up-to-date and more useful in making decisions. But the problem about fair value reporting, of course, it's very subjective, and it can lead to a considerable amount of volatility in the performance of a company during the year. But they're both regarded as key objectives within the financial statements: the stewardship objective and the decision-making objective. Chapter 2 is called the reporting entity. Now, Chapter 2 defines the boundaries of reporting entity. Now, that sounds very simple, because if you've got an individual company, you know what the boundary of that company is, or a partnership. That's simple. It's not easy, however, when you come to look at the group context, because in a group you have a parent company and you have subsidiaries. But unfortunately, over the years, a lot of companies have deliberately gone out of their way to invent what are sometimes called special purpose vehicles or special purpose entities, which have been deliberately drawn up to avoid being included with the legal definitions of subsidiaries. So in recent times, the International Board have come to the realization that they need to really define the group boundary from the point of view of the parent. If the parent is able to control the operating and financial affairs of another entity, then that entity should really be included within the boundary of the group accounts. And the words that they use are power to direct the activities of another entity. So if a parent has the power to direct the activities of another entity, that entity should effectively be consolidated within the group accounts. That does mean that there are situations where you could actually have a company that is consolidated and you have no shares in it, but you're able to control it by other means. And I think that hopefully will bring a stop to what happened, particularly with the Enron situation in America, where you had an awful lot of special purpose entities that were off balance sheet, and all the borrowings were off balance sheet, and therefore people weren't aware of what a serious position that group got into. So that's really Chapter 2. It's maybe simple enough in its theoretical context, but in a practical context it's difficult sometimes to define the boundary, particularly in the group area. Now, Chapter 3 is called the qualitative characteristics, and in the last couple of years they've decided to break these characteristics into two key subheadings. The first set are called fundamental qualitative characteristics. In other words, they're absolutely fundamental in providing a true and fair view. You cannot give a true and fair view unless you apply these qualitative characteristics. But then there are a couple which are argued to be enhancing qualitative characteristics. Now, they don't by themselves provide a true and fair view, but what they will do is they will make the true and fair view even better. They provide even better information for the user's point of view, but they're not fundamental to giving a true and fair view. Now, the two fundamental qualitative characteristics that are mentioned in the framework are relevance and faithful representation. Now, relevance basically means that we must produce information which is going to serve the needs of the users, to make them useful, particularly for making decisions or for confirming what has gone on in the past. And that again is another push, in my opinion, towards more fair value reporting. In the background, however, is that we as accountants, of course, should only look at material items. And we always have the problems in deciding where do you draw the line. I mean, you might take the view that an asset which costs under €1,000 is not material to your business, so you don't capitalize anything under 1,000. But then other companies might take the view it might be as high as 5,000. It depends on the individual circumstances of the company. But all of that's all about accountants concentrating on the information which is most relevant to meet the needs of the user. Faithful representation, which has just recently in the last couple of years taken over from reliability, means that we must faithfully represent the underlying transactions in our financial statements. Now, there's a number of subsets to that. First subset is that accountants must always override the law if, in their opinion, the law is not giving a true and fair view. We call that the substance. We apply the substance of a transaction over the legal form. We call it the override. We override the legal form where we believe that the commercial reality of a transaction has not properly been recorded. Now, the classic example of that, of course, is leasing, where the lessee has to report a finance lease on the balance sheet, even though they legally will never own that asset, or very rarely own that asset. Accountants are also supposed to be neutral. They're not supposed to, if you like, be under the sway of the chief executive officer and try to massage the figures in any way whatsoever. They've got to be totally independent and free of bias. So they must be neutral between both good and bad news. Prudence is also an important feature of faithful representation, in that accountants must not bring in income or assets unless you're pretty sure of those actually being realized. Whereas on the liability front, we're a little bit more prudent there. We make sure the fact that liabilities, as soon as they arise, as long as we've clearly got a liability, should be reported on the balance sheet as soon as possible. That is why, in fact, in construction contracts, we actually provide for all the losses right to the end of the contract, even if they haven't happened up to date. And of course, completeness means the information in the financial report must be sufficiently complete in order for a proper decision to be made about the decision to invest or not invest in the company. Now, the enhancing qualitative characteristics, one of the problems we've always had as accountants is trying to make information understood by non-accountants, and that's a very difficult operation to do. But our job is to try to make I often say, the accounts sing. Try to turn what is a very technically difficult subject into a subject which can be understood by the average person. And that's why you find there's a lot more emphasis nowadays on the front of the annual report, and certainly in December 2010 there was the publication of the management commentary, where they were trying to encourage a better framework of reporting in narrative terms what was actually happening in the figures later on. Because generally non-accountants understand narrative, they understand graphs, but they're not particularly good at the figure work. And to a certain extent that undermines a little bit the efficient markets hypothesis. Comparability is the other enhancing one, and that means that we must produce information in the same way every year, year after year, and obviously within the same accounting period. We used to call that consistency, and it's not really much different from consistency. So those are the four qualitative characteristics which underpin our accounting, and they should be at the back of our heads when we're deciding the most appropriate policies to choose for our company. Now, there is one assumption which is given. Chapter 4 actually covers absolutely everything else, because they're in the process of changing the whole structure of the conceptual framework. They've finalized the first 3 chapters, and they've kind of left everything else that hasn't been changed yet into chapter 4. And they have an assumption that they've left in chapter 4, a very important assumption, that when you're preparing your accounts, you're basically assuming that the company will still be here next year and the year after that it will be a genuine going concern. Otherwise, you'd have to prepare all the accounts on a break-up basis. So the going concern concept is very much alive and well. Chapter 4 then also deals with the elements of financial statements, which I personally believe is probably the most important chapter of all, because this tells you exactly what will go into the major primary statements. And they start off, which in their opinion is the most important document of all, is the statement of financial position, or what we used to call the balance sheet. Now, in that statement of financial position, there are 3 key elements: assets, liabilities, and equity. And what you simply do is you add up all your assets together, you take away your liabilities, and whatever's left over is called equity. So equity is simply defined as the residual interest in the assets of the enterprise after deducting all of its liabilities. So the key definitions are clearly assets and liabilities. Now, an asset is simply a resource controlled by the enterprise as a result of past transactions and events, and from which future economic benefits are expected to flow to the enterprise. Now, there's no mention there of ownership. All you have to make sure is you control the asset, and there will definitely be future benefits flowing from it. And again, I repeat, leasing is the classic example of that, where the lessee has to put the asset on the balance sheet even though they don't legally own it. Liabilities represent present obligations of the enterprise arising from past events or transactions, the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefits. Now, there's 2 types of obligation. There is a legal obligation, where you've signed a contract and you simply have to abide by the terms of that contract, or maybe it's a law has been passed and you have to abide by the law. Maybe some new environmental legislation has been brought in which will force you to bring a provision in for environmental damage or something like that. But then the more difficult one is what's called a constructive obligation. And a constructive obligation is a position you've got yourself into that you can't really get out of. You've basically, the example of that would be a termination or restructuring going on of your business, and you want to make a number of people redundant. Well, if you want to make a lot of people redundant and you want to put a provision through your books as a liability, first of all, you have to turn it from a mere intention to do this into a genuine constructive obligation. To achieve that, you need to inform the employees, either directly to themselves or through the trade unions, and secondly, you need to give them full details of the actual plan itself. How many people will lose their jobs? When will it happen? How much will it cost? All these things must be down in writing. Now, if you do that, then you've got yourself into a situation where there's a valid expectation that you will generally go ahead and carry out that operation. That is a constructive obligation. Now, those 3 definitions, assets, liabilities, and equity, are at the heart and soul of everything we do in accounting. Because if you then go down to what goes into the financial performance statements, and there's 2 of them, remember, there's the income statement and there is the statement of comprehensive income. Well, an income generally can only happen if your assets go up or your liabilities go down. Now, some of them are called revenues, and they go into the income statement, and some are called gains, like an actuarial gain, which will go through your statement of comprehensive income. An expense, completely the opposite of that, of course, is a decrease in your assets or an increase in your liabilities. And again, they could be broken down between what we would call genuine operating expenses, which go through the income statement, and then capital losses, if you like actuarial losses, revaluation losses, and things like that, which go through the statement of comprehensive income. But the important message here is that these are leftovers. The key in chapter 4 is to get your balance sheet right. Get your statement of financial position right at the start, get your statement of financial position right at the end, and essentially apart from new capital coming in and dividends going out, the difference between the opening and closing statement of financial position is your performance for the year. That effectively is the result of that. And that will result, I think, in a number of changes going to happen in financial reporting in the future. One classic example at the moment is in the area of grants. Now, at the moment, we basically use the accruals concept and we try to match the grant with its rate expenditure. But if you follow the international framework, what you should do is ask yourself a question. When I receive a grant, do I owe that money back to the government? Now, if I don't owe that money back to the government, that is income, because it's not a liability. It's not an obligation to transfer money to another party. It's mine. So it should go straight into income. And that's something which will probably result, I imagine, in the next 2 or 3 years, in international standard number 20 having to be changed in order to comply with this framework. Now, even though you may pass the actual definition of an asset or liability, that doesn't mean to say that you go onto the balance sheet. Because Chapter 4 then says that you have to pass 2 recognition criteria as well. So let's concentrate on the asset to try to illustrate this. The first test is that there must be sufficient evidence that a change in assets has occurred. Now, let's take an example of advertising. In advertising, why do you spend it? You spend the money in advertising because you hope to gain extra sales, additional sales. So it would probably might pass the definition of an asset. But it would fail this test because there is not sufficient evidence that spending that money on that advertising campaign will actually lead to future economic benefits. And therefore, advertising fails that test. And advertising, therefore, must be written off clearly as an expense inside your income statement. To illustrate the second one, can the cost stroke value of an asset be measured with sufficient reliability? Well, a classic example of that is that you've built up this fantastic brand name. You've got Guinness, you've got Kentucky Fried Chicken, McDonald's. These are all very well known brand names, but you won't find them on any company's balance sheet because they've been internally generated. And therefore it is impossible to work out sufficiently reliably what that cost or value might be. And therefore the related standard, which is known as IAS 38 on intangible assets, won't allow you to bring internally generated assets onto your balance sheet, apart from development, which is a slightly different situation. But on the other hand, if you were to buy a brand name, for example, Guinness bought over Bushmills whiskey in Northern Ireland a few years ago, and they have put a very substantial value on that brand name, and they've capitalized it on the books because they could, in that situation, measure it with sufficient reliability at the time of the takeover. So those are 2 very, very, very important tests, and you'll find those 2 tests or criteria included in nearly all of the standards when you're making this decision as to whether an asset or liability should be reported on your balance sheet. Moving into the next section, which is called measurement. This is a big problem for the International Board. There have been a number of different bases of measurement that have been talked about over the years, and unfortunately there is still no conclusion as to what is the correct or the best way to measure assets and liabilities on the balance sheet. I suppose we've grown up over the last 400 years with the idea that we should use the historical cost method. So we value most assets at cost, the cost of buying those assets on the first day. Even IAS 16, which is on property, plant, and equipment, says as an option you can use historical cost. So traditionally it's been the way to measure assets and liabilities. But it doesn't really provide very useful information for making decisions about the future. And certainly doesn't take into account the problems that we have with inflation. So, over the years, there have been various attempts to try to bring alternative measures in. One, which is mentioned in the document, is current cost, where you try to work out usually
the recoverable amount of the asset. You basically value all of your assets at the lower of the replacement cost or the recoverable amount. And the recoverable amount requires you to actually project future cash flows and discount them back to present value. And the selling value is basically the fair value less cost to sell and cost to complete. Now, those can be looked at separately, as you can see on the slide there. You can have all your assets at selling value, you could all your assets projected future cash flows back to present value. But the current cost is a kind of mixture of replacement cost, realizable values and present values. It was tried out in the 1980s in our country. We in fact in a local accounting standard called SSAP 16, which forced many companies to actually prepare two sets of accounts, one under historical cost accounts and another under current cost accounts. And that was all about the fact that the government in the UK and Ireland were trying to stop wage inflation at the time, and the idea was to try to maintain the operating capability of the business by making sure that we made sure that we could replace that capacity by charging in additional costs to protect our physical assets, additional costs to protect our monetary working capital and to protect our inventories. It was particularly important at that time because inflation was very, very high. It's kind of died a death since then. But it's still there in terms of the theory, and so we still really haven't, to be honest, come down to the conclusion as to what is the best method to use. And throughout a lot of the standards you will find at various points in time that they're using mixtures. For example, in IAS 36, which is the impairment standard, you will have to calculate selling values and you will have to calculate present values because you have to work out the recoverable amount of an asset if it gets into difficulty. So there's no conclusion, and I personally have the view that there are horses for courses, and maybe what we probably should be doing is preparing different sets of accounts for different users, and that's something maybe can be thought about in the future. But there's no agreement certainly as to what is the correct way to measure assets at present. That brings us then to the problems of capital maintenance. Now it's been clearly brought out that for any company to make a profit, they need to maintain their capital. In historical cost terms, it's always been we need to maintain the original capital put in by the owners and possibly also the retained profit, although that may not be the legal situation. But when you end up with inflation, and it doesn't really matter how high that inflation is, really, are you protecting yourself simply by standing still? Because if I buy an orange today for €2, I sell it for 4, and then I discover it's going to cost me €3 to replace it, well, if I distribute the 2 historical profit, I've only got €2 left, and yet it's going to cost me 3 to replace it. I can't do that, so my business has gone down. The size of my business has deteriorated. So over the years there have been attempts to try to say, well, look, what we should really be doing is trying to maintain the capital by protecting ourselves from the ravages effectively of inflation. Now the two major methods are to maintain the financial capital of the business, which really means the shareholders' funds, share capital reserves, and that technique has commonly been known as current purchasing power. Now it was used by our profession in the 1970s. There was actually a provisional SSAP 7 on current purchasing power at that time. And what you had to do was to adjust every single figure in the income statement and the balance sheet from its original date of transaction to the inflation at the end of the year. It was only using one index. It was the Consumer Price Index in Ireland and the Retail Price Index in the UK. But it was all about protecting shareholders' wealth. So in other words, the shareholders couldn't make profit until they had protect themselves from the ravage of general inflation. It's very simple. It wasn't difficult to operate, but unfortunately the government didn't like it, and they decided that they preferred to maintain the physical capability of the business, the means to operate at a certain level of goods and services. So unfortunately we had to, as a profession, get rid of SSAP 7 and move to SSAP 16, which is in current cost accounting, which is really a mixture, as I said before, of 3 values: value in use, replacement cost, and net realizable value. and you would use a technique called the deprival value. You would say, I'm going to value this asset at the amount I would feel deprived of if this asset was taken away from me. Now that was SSAP 16 on current cost accounting, but as I say, over the years, because inflation has been kept pretty low in the last 25 years, has kind of disappeared. Where it becomes important, this whole section in international accounting, is where you have hyperinflation. You have countries like Zimbabwe and not so long ago Turkey, who were suffering more than 100% inflation in a 3-year period. And that is why there's an international accounting standard known as IAS 29, which is based it's really for financial reporting in hyperinflationary economies. And what it really says, you have to use current purchasing power to adjust your historical cost accounts first before you translate them back into euros, if you like, for consolidation purposes. But that's really only used where there is severe hyperinflation occurring in the company. So to finish off this session, where the framework has become particularly important, the implications of it, it's very heavily employed in trying to make decisions as to have we got an asset or have we got an expense, the recognition of elements. Have we got an income or have we got a liability? And also the other area we've got to spend a lot of time is trying to determine, particularly in the group area, where do you draw the line for a group? What entities do you include within the group? So they've had a lot of issues surrounding that in practice. Where it has found it extremely difficult to solve the problems and it's been most challenged has been in the area of measurement and classification. How do you actually measure fair value of your financial instruments? How do you measure the recoverable amount when you're dealing with an impairment of some of your assets? How do you put in the fair value of any share options or equity-based compensation that you've given to your employees? How do you work out the actuarial gain or loss on a defined benefit scheme? These have caused the most difficulty and have resulted in quite a lot of disputes, if you like, within the profession. It's the right approach to deal with it. So to summarize, to finish off this session, there are 4 chapters in the actual framework as it stands, but it's going to be changed every year. The first chapter, we noted, was dealing with the objective of general purpose accounting, which is to meet the needs of users, and quite a selection of users, everything from investors right through to the general public, and of course to make sure that you met the 2 classic needs of making sure the information is confirming the past under the stewardship function and also helping users to make decisions about the future. Chapter 2 was all about defining the borders of a reporting entity, particularly important in the group area, where we have to decide what vehicles do we actually control. And if we control them, if we're able to direct the relevant activities of those vehicles, even though they may not be legal subsidiaries, they should be reported within the consolidated accounts of that reporting entity. The third chapter then went on to deal with the qualitative characteristics of useful information, and that dealt with the fundamental characteristics of relevance. It must make the information useful for making decisions, and also that every transaction must be faithfully represented by ensuring we always report the economic substance when it comes into conflict with the legal form. We must be neutral, non-biased in our opinion between good and bad news, and we must be prudent. And we also have the other enhancing elements as well, which basically make sure that the information must be understood by the reader as best as we possibly can, and we must also make sure the information is prepared in a comparable manner. The final chapter 4 is the remaining text, and that covers the underlying assumption that whenever we prepare a set of accounts, we're always going to be prepared under the going concern concept. We define then the key elements, and the main elements there are what is an asset, what's a liability, and what is equity. In other words, get your balance sheet right at the start, get your balance sheet right at the end, and the difference is effectively your income and expenses for the year. They are the leftovers. Then when you're looking at your assets and liabilities, the recognition criteria make sure that you have to pass 2 tests for an asset or liability to go on the balance sheet, apart from meeting the definition. So there must be, first of all, a probability of economic benefits flowing into the entity if it's an asset, and also there must be a reliable measure for the amount of that asset. And finally, the area where they still do not have complete agreement is measurement. There are different ways that you could measure assets, and it's quite difficult actually to come up with a conclusion as to what the right method is. And perhaps you might argue there are horses for courses, and maybe you should be using different measures for different purposes. Perhaps you might be using selling values for creditors to protect their amount that they're owed. Maybe we should be using more futuristic information for shareholders because they're interested in the future viability of the company. And maybe historical costs from the point of view of the tax collector and the government. So there are different needs, and therefore maybe we should meet those different needs by measuring the elements in different ways. But at the moment it's a bit of a mixture of measurement bases that we actually use. So that concludes the presentation on the conceptual framework. As I said at the outset, this is probably one of the most important documents that any student should be studying in their financial reporting, because if you're ever stuck, whether it be dealing with property, plant, and equipment, or inventories, or liabilities, any subject whatsoever, you can always refer back to the conceptual framework, and you can never ever go wrong. And it's interesting to note that in the new FRS 102, which is going to apply to all non-listed companies in Ireland, they've actually included the conceptual framework into chapter 2 of that document. So it's now going to be enshrined in the standard, which is going to apply to the vast majority of companies in these islands. That is how important the framework is. Thank you for listening.